Evening, everyone. It gives me immense pleasure to welcome all of you to the live virtual sessions for CA Final Paper 4, Direct Tax Laws and International Taxation for the students who are going to appear for May 27 and November 27 examinations. See, dear students, please note my words that सफलता संयोग से नहीं संकल्प से मिलती है और संकल्प तब सफल होता है जब तैयारी निरंतर होती है. That means you have to be consistently prepared. You have to consistently practice this paper to score a good marks. And this year, specifically this year, with the introduction of the new income tax law 2025 with effect from 1st April 2026 makes a historic milestone for India, right? From May 27 examination, you all are knowing that from May 27 examinations onwards, the new Income Tax Act as amended by the Finance Act 2026 will be relevant for you. That means you have to prepare. You have to, again, unlearn the provisions of the Income Tax Act 1961 and learn the provisions of the new Income Tax Act. See, students, the income tax rules also 2026 are relevant for you. And in the new act itself, amendments are being made by the Finance Act 2026. And this has become all know that the direct tax laws paper is one of the most dynamic paper, and the beauty of this paper lies into its changes every year. And students, see the new, so don't worry, who have done, you have prepared, and those who are doing their practice also, they must be doing their tax audits and filing their income tax return as per the existing repealed Income Tax Act 1961. But for the examination, you are going to appear for May 27. And for that, you have to learn the new income tax provisions. Many of you must be having doubts that you have not been still provided the study material. See, students, we have now started with our LBC classes. And from these classes, please, you start your preparation with the help of these classes. And as and when we are updating our chapters, we will be uploading also on the portal. But meanwhile, very soon, we will be uploading module 1 chapters on our website. But before that, Prerna ma'am, today our faculty is CA Prerna ma'am. And she will be taking you through this chapter 1, that is basic concepts, and that is being amended. That chapter itself of their study material is updated as per the new Income Tax Act 2025. And that chapter, again, we will be uploading as a notes for you that you please refer for and start your preparation from those notes. Assignments also we will be uploading on our portal. So, it doesn't mean, see, if the new act is there, it doesn't mean that you have to follow all the provisions, whatever you have learned. It is not like that. In the new Income Tax Act, the law has been rewritten in a simpler and more structured manner. Am I right, Prerna? And it is important. See, it is not merely renumbering exercises. The new legislation introduces a fresh framework. For example, the charitable trust, if you talk about, they have, come out with a new provisions, that is section 332 to 355 is the whole code for the charitable trust. Earlier there were this regime, first regime and the second regimes. Section 1023C contains itself so many provisos, around 23 provisos were there, so many explanations were there. The section 1112 contains many explanations. Now everything is so simplified in the new act. It will become easy for you. If you want to start your studies from the bare act also, you can do it, because now it becomes really very easy. And for our final students, it is always advisable that please refer the Income Tax Act, and that to 2025 as amended by the Finance 26 Act is really becoming so simple that you can start your studies. You should not wait for the, of course, the study material we will be providing for you to support your academic things, but definitely you can start from the bare act also, right? You know the syllabus, you know your syllabus. So before moving, before giving you this platform to Prerna ma'am, I would like to tell you students, uh, because many students must be having some doubts, is there any changes in the syllabus of the CA final examination? Frankly speaking, there are no changes in the syllabus. Okay, there are no changes in the syllabus except that your, we can say, ki Income Tax Act 1961 wherever is written, it being changed to 2025. Right, apart from that, it's being written that the assessment of charitable trust or institution, now we have to write the assessment of registered non-profit organizations instead of trust and institutions. Right, this is the change. But one of the important thing which I would like to share before you, because you should know what is the syllabus you have to study for. You should know, because for the final students, if you talk about, the whole of your syllabus is divided into three parts, three sections. Major sections are three sections. First is the substantive law of the direct tax laws, income tax law. Then it comes to your procedural law of the direct taxes and your international taxation. These are the three major sections in which whole of your study material, whole of your syllabus is divided. And to cover this syllabus, we are coming out with the 4 modules. The first 2 modules are relating to your first section, that is substantive provisions of law. That is from chapter 1 to chapter 12. Okay. And from chapter 13 to chapter 20 are based on the procedural law, that is withholding taxes, TDS provisions, tax collection provisions, procedural law, assessment procedure, till your tax audit provisions. Then the last module, module 3, comprises of chapter 13 to 20, and the last module 4, which is on international taxation. So just let me share you, there is one change in the section wise weightages. You all know that earlier equalization levy was there. Now equalization levy is no more relevant. It's being withdrawn, abolished. The equalization levy, both 6% and 2%, have been withdrawn. On account of that, if you get to the chapter 12, which is on taxation on digital transaction, now it is covering only the virtual digital assets concepts and of course, the OECD recommendations relating to the digital places. In that aspect, I would like to share with you, this is important for you, and you will be getting very soon from the website also, the section-wise weightages. What is the change in the section-wise weightages? So what you can do, of course, we will be in these classes, we will be following the chapters in the manner we have given you. And this is, you are, first time preparing for the subject. So do it thoroughly, holistically, and in depth study of entire study material, entire syllabus. Once you have done your study material, once you have completed your LBC classes, of course, then you can pick up the sections which you feel are easily to do it. For example, you can pick up the international taxation initially, then you can move to your substantive provisions, then of course the procedural law. Whatever way you like the procedural law, that you can take up earlier. So second revision, you can, of course, some shifting is possible. So if you notice section-wise weightages, in these section-wise weightages, if you notice, the first section, which is comprising of 2 subsections, which is comprising of 2 subsection. I should increase its size. I think it must be visible to you. So in this subsection, earlier there were 2 parts. And now in the first subsection, which is on up to chapter 9, I must say, computation of total income and tax liability of various entities. And the weightage assigned to that portion was 20 to 23%. And it comprising of a whole lot. You have to study up to deductions from GTI, then of course you have to compare and compute the total income and tax liability, whole many content over there. So that has been increased from 20% to 23% to 27 to 30%. So now major chunk will be from this part 1. And in the subpart 2, earlier the weightage assigned was 20 to 22%. Almost earlier the weightage were on the similar lines, but now it has been reduced. Why? Because it's only comprising of the now RNPO provisions, your investment funds provisions, business trust, securitization trust, and political parties. Then your GAR provisions, of course, are there, and your VDA. At presently in Chapter 12, if you go through, if you will go see that on virtual digital assets taxability is contained. So 13 to 15% weightage is assigned to here. It was reduced in the first part. These section-wise weightages are increased, and in the subpart 2, the section-wise weightages are being reduced. Okay, it's to 13 to 15%. And your procedural law, it remains the same. That was earlier 20 to 30% are allotted to for procedural law, and for international taxation again it remains the same. That is 30% to 35%. So there are no changes in the syllabus per se, but there are changes in the section 5 weightages. Okay, so you have to accordingly do your preparation. Focus on easily in this 27 to 30% weightages, and of course one or the other question would be asked from every section. There is a specific weightages assigned, so you have to prepare it thoroughly and in depth for everything. This is about the section wise weightages. For study material, we are receiving so many queries. Again, I'm telling you, we have already started from today onwards LBC classes. Please do join these LBC classes. You will get the updated chapters by way of notes. Plus, module-wise web hosting we will be soon starting. And of course, getting the material in the physical form will take some time. Meanwhile, you please start your preparation from these LBC classes. And of course, the objective of these LPC classes is, to build your concepts, to understand the rationale behind every provisions. You all should, since Finance Act has made certain changes, which you have not, if you have already appeared for the earlier examinations, this is the crucial document, you should refer the memorandum explaining the finance bill amendments, because it provides you the basis why this provisions is being amended, why this provision is being inserted, why it was being introduced. So concept building is very, very, very essential for you. And the objective of our LBC class is that, of course, exam oriented also. You should study. Of course, everyone are studying for the exam purposes, but it's very necessary that you should have the understanding also. Quality education matters for you, not only for passing the examination, but after becoming a chartered accountant, it really matters for you, right? Application oriented, if you see, evaluation synthesis skills are being tested, application oriented skills are being tested in this paper, and this comprehension and knowledge, because knowledge based questions are not very much weightage is given for this comprehension and knowledge based. Only 5 to 10% weightage is given. So as you know that the last 4 chapters of the module 4, which is on the BEPS, application and interpretation of tax treaties, model tax conventions overview, and the latest developments are taking place in taxation, mainly the question is being asked from that portion relating to this skills, comprehension, knowledge. Okay, so students, this is about, so we can now start our journey with confidence, dedication, and enthusiasm. And definitely note my points again, that consistency beats intensity. When intensity cannot be sustained, so you should be consistent. ऐसा नहीं है कि last के 1 month आपके intensify हो जाओगे, you can learn everything in 1 or 2 months. It would not be possible. You have to be consistent for the subject, right? So Prerna, welcome you for taking this session. Now I am handing over this platform to CA Prerna Bishori ma'am. She is the today's faculty for you. She will be taking you through the first chapter, basic concepts. Prerna.
Thank you so much, ma'am. Yes. Let me just share the screen. Good evening, students. First of all, welcome to this session on the basic concepts, and the very first session with respect to your direct tax paper. I'm not able to, yeah, just once. I hope my screen is visible. Yeah. So students, this is, as Aparna ma'am was rightly pointing out, that this is a, like entire new thing that you have an opportunity now to study. In your inter, you would have studied the Income Tax Act 1961. Now, as you are aware, this has been completely overhauled. Like, we do not have now Income Tax Act 1961, that is abolished. Now we have replacement of that as Income Tax Act 2025, which is supposed to be a streamlined, simplified and a modern version of the 1961 Act. See what had happened over the period of time, that there were so many amendments that were carried out each year through the Finance Act, because of which the Income Tax Act had become very bulkier, right? So as Aparna ma'am was mentioning to you, for example, if we refer to 1023C of the 1961 Act, right? There were so many explanations, provisos added to it. There were two separate schemes operating for charitable trust, one for 1023C, another was for section 11 and 12 scheme which was there. So there were two regimes that were operating parallelly, right? So it was creating a lot of confusions. Every year it used to happen that the government used to make amendment in one of the regime, the other regime was not again streamlined with it. So again next year there were so many amendments into it. So that entire 1023C itself was like a chapter of an income tax act. It was so huge. And similarly, if you look at it, there were so many things where everything was put under one particular section through the provisos, through the explanations to explain a particular term, but all of that resulted in a very bulkier act. So if you can see on my screen right now, from 819 sections we have come to 536 sections, because there were also so many sections that were obsolete, which had been omitted long back, but the numbers still remain. If you look at the TDS section, we started with 192, we had something 194 ST, all of those sections, right? So there were like too many sections. Everything was like very bulky in terms of section. It gave a difficulty for a common man to interpret the Income Tax Act 1961. So the vision of the government with respect to creating a new Income Tax Act 2025 was to streamline it, to make it simpler to understand, so that it also reduces the interpretational issues, to provide the clear definition, right? So the Income Tax Act 1961 was created in 60s. Now we are 6 decades ahead today. So it had become very complicated and difficult to navigate. One thing was written at one place, for example, as I was talking to you about 1023C and 11. There were cross references again and again between them. So this new act is aimed towards presenting the same tax policy in a more logical, accessible and reader-friendly format. So to promote the ease of doing business. So basically, it is not something that, everything has changed under the new Income Tax Act. Because, if you talk about the Income Tax Act 2025, it has been just streamlined. It has been made in a simpler way, easier to navigate, easier to understand. But the tax policy remains the same. The tax rates remain what it was. Of course, tax rates keep changing, slab rates and all of that. But nothing so far has changed drastically in terms of, the tax rate for companies, for partnerships and all of that. Right? Nothing has changed in terms of what deductions were available to you in the 1961 Act and what are available to you now. So everything that in terms of the tax policy remains same. It is just presented more logically. So the Income Tax Act 2025 is now completely replacing the 1961 Act from the 1st April 2026. Right? And the exercise of the government was simply to reduce the number of these sections, make it simpler. So if you see, there were earlier 14 schedules, now it is 16 schedules. So schedules have increased. There were earlier 511 rules. See, we cannot just rely on the old income tax rules now. Because of the new act, we also have new income tax rules 2026. So from 511 rules, we have come to 333 rules. From 399 compliance forms, we have only now 190 forms, which makes a reduction to 52%. Are we understanding it? So this is such a drastic reduction. There were earlier so many forms that one needed to file. All of that have been streamlined. So 2025 is not imposing any new tax, any new deductions, any new overhaul is not there. The intent was just to make the structural change, to reduce the interpretational disputes. So the language has been made very simpler. The cross-referencing which was there earlier have been reduced. The provisos have been completely eliminated. The explanations have been completely eliminated. If you go to any of our previous lectures, you would see we focus so much in the basic concept class itself on understanding how to interpret the proviso, how to interpret the explanation, because those were the so much integrated with the section itself. The provisos used to provide the exception to the main section. The explanations used to clarify the meaning of the section. But there were so many interpretational challenges with respect to that. So this particular new Income Tax Act, all the explanation and the provisos have been eliminated and incorporated into the main text of the section itself. The sections have been reworded in the form of the tables and the formulas, so to make it more reader friendly. For example, if you earlier go to the Income Tax Act 1965 in the TDS sections, if you go 192, 193, 194J, all of those were the sections. Now everything has been put into the table under section 393. And therefore it is much easier to understand. Right? So this is what has been just a reorganization which have been taken up due to the decades of amendment making the 1961 Act very, very bulky. Now, one more important change that has taken place in the new Income Tax Act 2025. So that is in relation to the changing the concept of the previous year and the assessment year to the tax year. So in the new Income Tax Act 2025, you will not find the concept of the previous year and the assessment year. That has been changed altogether. Now we are calling it as the tax year. Combined. It is not that, now we do not have a previous year and assessment year. Or the income will be taxed in the same year and collected also in the same year. It's not like that. Just because this terminology of previous year and assessment year was not very globally aligned. So globally, you will not find people talking about income earned in previous year shall be charged or collected in the assessment year. Nothing like that is there in any tax law of the world. So that is the reason, to align it with the global practices, they have come up with the concept of the tax year, which is nothing but your financial year only, which is going to serve both the purpose. So let's say, for example, today if we would have looked at the 1961 Act, we would have said that this is previous year 26-27 and the assessment year will be 27-28. Here I am going to say income of the tax year 26-27 shall be charged or collected in the tax year 27-28. So we are going to make a reference to the tax year. So let's say, for example, tax year 24-25 is previous year 24-25 of the 1961 Act, which corresponds to the assessment year 25-26 of the 1961 Act. See, these are the screenshots I have taken from the FAQs published by the income tax website. They have published the FAQs regarding the new Income Tax Act, and I have taken that in the. So the previous year concept which is there has been changed to now the tax year. Right? So these are some of the major changes that have taken place. And therefore, now with that, background to you, let us start with the chapter on the basic concepts. So in this particular chapter, we are going to look at the basic, concepts of the income tax law, right? How do we interpret the income tax law, right? We are also going to talk about the tax rates which are there, right? On the different category of the person. We are going to talk about the capital versus revenue income or expenditure. And we are going to talk about some other basic concepts. So essentially in this particular chapter, our focus is on understanding the basic concepts, right? So first of all, going back to the very basic question, how does the tax collection happens? See, the constitution has to give me the power to charge or levy any tax. I cannot be collecting or levying any tax without the authorization under the Constitution of India. Right? So, Article 265 just give me a minute. Of the Constitution provides me that no tax shall be collected or levied except by the authority of the law. No tax shall be levied or collected except by the authority of law. This is what my Article 265 tells me. So, therefore, the question arises that where is the authorization given for that? So, you have to see the 7th schedule. Article 246 of the Constitution of India. The 7th schedule to Article 246. It contains 3 lists. So, basically, if I talk about Article 246, seventh schedule, it consists of the 3 lists, which enumerate the matters on which the Parliament, list 1, talks about where the subject matters on which the Parliament have the authority to make laws. List 2 talks about the matters on which the state legislature have the power to make the law. And list 3 is the concurrent list. So list 1 is the union list, list 2 is the state list, and third is the concurrent list, where both the Parliament and the state legislature have the powers to make the laws. Now, list 1 of the 7th schedule consists of the entry number 82, which is the taxes on income. So, in the list 1, entry 82 is the taxes on income other than the agricultural income. Why other than the agricultural income? Because agricultural income is covered under list 2 on which the state legislature have the power to tax. And therefore, the agricultural income is excluded in entry 82. And therefore, you see under the Income Tax Act, the agricultural income is exempt. Right? So entry 82 says the taxes on income other than the agricultural income. So basically here the parliament has the power to legislate the law in relation to the taxes on income. So now you understand from 265 that no taxes can be collected except by the authority of the law. Right? And that is the reason why you see that the Income Tax Act is passed as a money bill. It gets passed in the Lok Sabha, then it is approved in the Rajya Sabha, and then it becomes the act after the presidential assent. So, because the parliament has the power. Are we clear? Now, it says taxes on the income. So, when I talk about the taxes on the income, tell me one thing, what is the difference between the direct tax and an indirect tax? Indirect tax a tax on the income? Yes, is indirect tax a tax on the income? The answer is no. The indirect tax is basically on the sale of the goods, on the manufacturing of the goods. It is a consumption-based tax. The direct tax is the tax on the income which is earned by a person. It is direct in nature. The indirect tax is on the consumption. So the question in indirect tax is often, where are you consuming the goods or services? If you are consuming the goods or services in India, you have the GST. If you are consuming the goods or services outside India, there is no GST. Why? So if you see on the export of goods, those are zero rated. There is no GST on it because the consumption is taking place outside India. But when you talk about the import of the goods, there is a GST on it because the goods are being consumed in India. Whereas in that particular case, the tax is not borne by the person who is manufacturing or selling it. The tax is borne by the final consumer. It is passed on to the final customer because the manufacturer or the trader will get the ITC, input tax credit. Right? So the indirect tax which is there, that is kind of a regressive tax. It is 18% GST on for everybody. How much ever your income level is, even if I earn 1,000 rupees a day, even if I earn, let's say, 100 rupees a day, I will pay the same GST as Mr. Ambani would pay. Right? However, the income tax is progressive. The more you earn, the higher tax you will pay. Right? In the income tax, in the direct tax, the question is, who is earning the income? And on that person's income, the tax is charged. So it is a personal tax. Even though it includes the corporate, but it is on the person who is earning the income. Right? So that is what we mean here by the taxes on the income. Okay. So now if you understand that we have the entry 82 talking about the taxes on the income. So by that entry 82, the Income Tax Act takes the birth. In the income tax, for understanding the income tax, you don't just refer to the ICAI 2025. You also need to consider the income tax rules 2026. What does the rules do? The Act, of course, lays down the charge, the taxing rights, all of that. But what are the income tax rules? The income tax rules provide the workability of the Act. The rules basically provide the functionality to the Act. Those contains the administrative provision. For example, how does the income tax officer will know what is the income that you are earning? You have to file the income tax returns. That returns are emanating through the rules. The rules notify the income tax forms. Which form is applicable to you for what kind of income, isn't it? How does the tax officer will know whether you want to opt in for a particular deduction, right? Or for, let's say, particular exemption. The forms, the election will be done through the income tax, through the forms which are prescribed under the income tax rules. For example, if you go for the concessional tax rate for a corporate and you want to exercise that option, you have to do it through a form. That form is provided in the rules. So the rules basically provide for the effective implementation of the provision of the Act. So in the Act, wherever you will see as may be prescribed, it is written commonly in the Act as may be prescribed, in the prescribed manner. The prescribed forms, the prescribed authority. For example, who will give you the authorization to go for this particular provision? The reference has to be made to the income tax rule. It will be given in the income tax rules. Sometimes there are prescribed limits for the salaries exemption, HRA, all of that, right? Where would you get that prescribed limit? In the rules. So the will authorize the rules. Because see, why the rules are there? The rules are there essentially because if I put everything under the Act, now let's say for example, if I want to revise the limits of HRA, LTA, all of that, I will have to again and again do the legislative amendment through the parliamentary procedure year on year. I have to take the approval from the Lok Sabha, from the Rajya Sabha, so money bill will get introduced, all of that. But if I delegate everything to the income tax rules, it will be easier to amend these, small changes. So the Act will delegate it to the rules. And the rules are either notified by the central government or by the CBDT. So the authorization to notify these limits, these forms, because these are some of the implementative provisions in whatever is given in the rules to make the Act functional. For identifying which return one should file, ITR 1, 2, 3, whatever, you can't go for the parliamentary approval. Parliament has many more things to do. So therefore, these powers are delegated either to CBDT or to the central government. So therefore, you will see a lot of places in the Act, you will make a reference to the as may be prescribed authority, or prescribed forms. So that means you have to go to the income tax rules. The third important aspect, what you have to read along with the Income Tax Act, is the Annual Finance Act. Again, this is very, very important. Because the Finance Act will be amending the Income Tax Act annually. It will introduce the tax rates. Now the slab rates, the other tax rates for the corporates, general rates which are there, are not given under the Income Tax Act. These are always notified through the Finance Act. So you have to read the Income Tax Act with the Finance Act. So for this year, which Finance Act is applicable to you? It is the Finance Act 2026. Right? So this gets first introduced in the Lok Sabha through the Union Budget on 1st of February every year, isn't it? And then it gets passed as the money bill. So the Finance Act will list out the amendments to be made into the Income Tax Act, will list out the tax rates which are applicable. For the purposes of the tax rate, which are there, where do you find the tax rates? So there are schedules to the Finance Act. The first schedule to the Finance Act. The first schedule to the Finance Act talks about the tax rates. What will be my tax rate? We are going to talk about it. Okay. Then apart from the Finance Act, what you else need to do? Refer to circulars and the notifications. Now, what is the difference between the circulars and the notification? So the circulars which are there are essentially to clarify something in the Income Tax Act. These are issued by the CBDT. So, for example, there were certain, doubts with respect to on what amount TDS has to be deducted, on which transactions TDS have to be deducted. So, for example, with respect to the perquisite, the TDS on the perquisites, the TDS on the virtual digital assets. So there are circulars which provide the guidance. Now these circulars are issued by the CBDT to clarify the doubts. Now remember, these are issued just as guidelines. These are binding on the income tax authorities, but not on the assessee. So the circulars which are there, these are binding on the income tax authority. Why these are binding only on the income tax authorities? Because these are issued by the CBDT. So CBDT is, the legislative body which is, governing the Income Tax Act. So the CBDT which is there is essentially the statutory authority. Right? It is constituted again by the Act of Parliament. So the CBDT which is there, it is the apex body which is entrusted with the task of administering the Income Tax Act. So CBDT administers the Income Tax Act. And then you have the income tax authorities under the CBDT. So obviously they will be bound by their highest authority. But these are not, the circulars are not binding on the assessee. Okay. So these essentially are the guidelines. Then you have the income tax notifications. What are the income tax notifications? Notifications are nothing but to notify something. Right? So, it will basically give some sort of notification that these are the authorities who are going to be approving your, let's say, registrations. These are the rules, so these are the income tax forms which are going to be applicable for your filing of return. So any sort of rules which are there are notified. So notifications can be issued by the CBDT, because if it has to come up with some income tax rule, it will issue it through a notification. So notification is just published as a document in official gazette to notify everybody that this is the change which is taking place in the income tax rules. It can be issued by a central government also. So whosoever has the authority under the rules can issue a notification. Then finally, you also need to make a reference to the judicial pronouncements. This is again very, very important. So you have to look at what are the income tax appellate tribunal giving the judgments, because that may be having a lot of implication on your case. What are the High Court judgments saying? What are the Supreme Court judgments saying? Because if your case is similar, so in that particular case, you can rely on that judgment, because the judgments are going to clarify the law. They are going to interpret the law, right? So it is very important that you follow the historical cases, right? So there is this doctrine of stare decisis, which essentially means you have to follow the historical cases and established rulings, right? So that is what, as a combined thing, you need to understand when you are interpreting the income tax law. You can't just be only referring to Income Tax Act. Even for the purposes of your study, you have to refer to all of this in consonants. Obviously, you don't need to go through all the notifications which are there. There are many notifications which are issued. But whatever are relevant, you need to go through that. Are we clear? So this is how you have to understand the Income Tax Act. Okay. Now, the Income Tax Act 2025 is coming into effect from the 1st April 2026. So this will apply to the tax year 26-27. This is applicable to the whole of India, right? And for this particular tax year 26-27, see, both the act will run parallelly. Income Tax Act 2025 and Income Tax Act 1961. I'll tell you why. So, till 31st March 2026, what was applicable? Income Tax Act 1961, right? So, after this date, after 31st March 2026, after this date, from 1st April 26, we have the ITA 2025 coming into picture. Isn't it? So, for this previous year 25-26, for which the assessment year is 26-27, isn't it? The Income Tax Act 1961 will be applicable in this assessment year also, right? So whatever income was earned in 25-26 is going to be assessed in 26-27. For example, for TDS up to 31st March 2026, it was to be paid 30th April 26, right? The TDS return filing for this was for Q4 26 was basically 31st May 26. For your income tax return filing for the previous year 25-26, the due dates are in 2026, your July, September, October. Similarly, for your audits, the due dates are in 2026, October, November, right? So, whether these return filings, TDS payments, self-assessment taxes are to be paid in the Income Tax Act 2025, the answer is no. The Income Tax Act 2025 is applicable in relation to the income earned in tax year 2026. So for the income which is getting earned from 1st of April 26-27, the Income Tax Act 2025 will be applicable. But the income which has been earned last year, in the previous year 25-26, for which the assessment is going to happen now, you have the Income Tax Act 1961 functioning. So even this is not just going to be for 26-27. This is also going to be a longer period. See, this will get over. The audits, ITR filing, TDS return, all of that. The updated return, the timeline is for 48 months. That will go on until 2027-28 also. Similarly, your assessment notices. The assessments taking place, the appeals that are ongoing, all of this which is pertaining to the income earned before 2026 1st April will be governed by ITA 1961. The outstanding refunds which are not issued, refund of tax. So all of this pertaining to the income earned prior to 1/4/26, right, will be governed by Income Tax Act 1961. Right? So both the acts will operate parallelly, because you cannot ask the taxpayers now to file the new forms in Income Tax Act 2025. You cannot ask them that the assessment which was for the income which had started in, let's say, before 31st March 2026 will be completed as per the new Income Tax Act. Can't be. So therefore, there is a section introduced which is section 536, savings provision or saving provision, or you can also call it as the transitional provision. This will provide for the transitional mechanism to ensure the smooth transition from 1961 to 2025. So what does this say? So let me take you to the section itself. We are going into the bare reading of the provision now. Okay. It is very important to refer to the bare act. So this is our incometaxindia.gov.in website. On this, you will find the Income Tax Act. Here you will see Income Tax Act 2025. We will go to this and we'll select here section 536. Repeal and Savings Clause. What does it say? The Income Tax Act 1961 is hereby repealed. So this particular section which is there is repealing the 1961 Act. And then it says, irrespective of the repeal of the 1961 Act and subject to the subsection 4, nothing shall affect the previous operation of the repealed Income Tax Act and the orders or anything duly done or suffered thereunder. Meaning what? That whatever income that you earned and which was charged to tax, whatever assessment orders were passed, whatever taxes that you have paid, whatever you have done under the Income Tax Act, 1961. Now you cannot say if something has changed in 2025, you can't say no, this is not applicable to me. 1961 is now not applicable. I want to change it. So irrespective of the repeal, the 2025 will not affect whatever has been done in the 1961 Act. First point. Nothing shall affect any right, privilege, obligation, or liability acquired, accrued, incurred under the repealed Income Tax Act or orders under the repealed Act. So if you have any right to claim the refund, if your any outstanding refund is there in the 1961 Act, and let's say today the interest on that income tax refund has changed in 2025. Let's say earlier it was 0.5%. Let's say, I'm just giving an example, it is not changed. But let's say now the income tax at 2025 increases it to 1%. You can't claim 1% now. You were having the right to claim 0.5. Or let's say now 0.5 is reduced to 0.25, you can still claim 0.5. You have the accrued right to get that refund which is due under the 1961 Act and the interest on that as per the 1961 Act. So the repealing of the 1961 Act will not affect your any right that you have, any privilege that you may have, any tax obligation that you had to pay under the old Act, let's say some income tax demand. And let's say the interest on the late payment of the demand is 1%. Now it is, let's say, reduced to 0.5%. So obviously you cannot say, no, I will pay only 0.5%. That is not possible. So you have to pay what is the liability due. Okay. So this new Income Tax Act will not affect any right, privileges, obligation or liabilities acquired, accrued or incurred under the earlier Act. Then the provision of the repealed Income Tax Act shall continue to apply to any proceeding pending on the date of commencement of this Act. If any assessment proceedings, search proceedings, appeal proceedings are pending, which had started in the before 1st April 2026. So the old Income Tax Act only will be applicable on those proceedings. And also, so not only the proceedings which have started before 31st March 26, but even any proceedings initiated after 1st April 26. including any notices, assessment, reassessment, recomputation of income, rectifications which are there, penalties which are there, references to the commissioners which are there, revision orders which are there, appeals which are there, which are started or initiated after 1st April 2026. In respect of any tax year, see, they are not referring here previous year because here the previous year concept is not there. In respect of any tax year beginning before the 1st April 26, such proceedings shall be carried out as per the procedure specified in the repealed income tax. So, if the new act now is prescribing a new way to file returns, new way to file the appeals, new forms to file their rectifications or revisions, so that will not be applicable to you. So if the income is pertaining to the tax year prior to 2026, 1st April 26, the assessment proceeding, appeal, rectification, revision, penalty proceeding, all of that will be carried out as per the 1961 Act. Any proceeding for the imposition of a penalty in respect of any tax year beginning before the 1st April 2026 may be initiated and any such penalty may be imposed under the repealed Income Tax Act as if this act had not been enacted. So even the penalty in respect of any tax year pertaining to prior to 2026. If the income was earned prior to 2026, the penalty will be charged as per the old Income Tax Act. Any proceeding pending on the commencement of this act before any income tax authority or any other authority constituted under the repealed Income Tax Act, appellate tribunal or any court by way of application, appeal, reference or revision or by any other means shall be continued and disposed of as if this act had not been enacted. So any proceeding which is pending before any assessment proceedings, any kind of, let's say rejection orders made under the charitable trust. So any proceeding which are pending in relation to that, any appeals are pending, any applications which are pending for let's say the approval of the trust or the non-profit organization will be continued under the old act. Then any election or declaration made or option exercised by an assessee under the provision of the repealed Income Tax Act and in force immediately before the commencement of this act shall be deemed to have been an election or declaration made or option exercised under the corresponding provision of this act. Let's say a company has elected the option of going as per the concessional tax regime under the old act. Now, will it have to again exercise the option under the new act? No. Any election made, any declaration made, any option exercised under the old act will be deemed to be exercised under the new act, and that company need not exercise that option again. Are we getting this? Where in respect of any proceeding relating to any tax year beginning before 1st April 26, a refund falls due on or after such date, or a default is made on or after such date in the payment of any sum due under such proceeding. So, if any proceeding which was there, any assessment proceedings, appeal proceedings which were there before 1st April 2026, and with respect to that, under that, a refund has been granted to you. You are going to get a refund of your income tax, or you're supposed to pay your income tax liability, right? Which is going to be made after 1st April 2026. The provisions of the repealed Income Tax Act relating to the interest payable by the central government on refunds or the interest payable by the assessee for default shall apply for the period on or after such date, subject to the effect that the rate of interest on the refund or on default, as the case may be, as provided in the repealed Income Tax Act, has been substituted with the rate as provided in the corresponding provision of this Act. and such substitution shall apply from the date on which such rate has been modified under this Act. So essentially, what are they trying to say here? That if any interest is to be paid on your refunds, or any interest is to be paid by you for default in making the payment of the taxes, then provisions of the Income Tax Act 1961 will be applicable. So as I gave you an example that if let's say you were due to get 0.5% on the refund, so you will get the 0.5% only. So in that particular case, if you are given any sort of, or if you have not made the payment, and let's say for example, you were supposed to pay 1% interest. So in that particular case, you will be required to pay as per the old Income Tax Act only. Are we getting particular point? So if a person had an outstanding tax liability under the old Act, he has to still pay under the new Act. It is not that under the new Act, the Income Tax Department will not recover. They will recover. Similarly, if any refunds are payable to you, you will get under the new Act. And with respect to the interest on that, the interest will be applicable as per your old Act. Are we getting this particular point? So, in respect of not only the interest on the self-assessment tax, it could be interest on not paying the TDS. Right? It can be any sort of interest on the refunds. So, you have to ensure that whatever interest is payable, you need to pay as per your 234A, 234B, 234C. Obviously, there is no change in the interest rate at the moment. But what if the interest rates changes? Right? So in that particular case, the Act is very clearly telling you that it shall apply the old provisions of the Repeal Act. Are we clear? But if there is some sort of modification in the new Income Tax Act, then the rate of the interest on the refund or on the default, which is there, which is provided in the 1961 Act, will be substituted with the rate given under the new Income Tax Act. Will be substituted once the substitution takes the effect. Once the modification comes into effect, if the law changes later. But at this point, you will get as per the old Income Tax Act. If later on, of course, they change the law, let's say next Finance Act, they pass an amendment changing the interest rates. Then, yes, you will get the new interest rate. But if today there is a difference in the interest rate, you will go as per the 1961 Act. Are we clear? When any sum has been allowed as a deduction or has not been included in the total income of any person, either on account of fulfillment of certain conditions or for other reason, for any tax year beginning before 1st April 2026, and any such sum was required to be included in the total income of any subsequent tax year, including the beginning on or after 1st April 26 under the repealed Income Tax Act, if it had not been so repealed on account of violation of such condition or for any other reason, then such sum shall be deemed to be the income of the subsequent tax year and included in the total income of the said person under the same head of income as it would have been included under the repealed Income Tax Act. So let's say, for example, if you had claimed certain deduction or if your some exemption was there on your income, right? If you had certain exempt income, Now, there are certain categories of exempt income that if you do not fulfill those conditions, you will not get the exemption or you will not get the deduction. And let's say you violated that condition. For example, you get deduction with respect to the housing projects, you get deduction with respect to the specified businesses, right? So now there are certain conditions that the expense cannot be for the, like, you cannot sell the asset within the period of 8 years. If you sell the asset, if you discard the asset, you will not get that particular deduction, right? Or you have to file the return of income, otherwise you will not get the deduction. Or there are certain conditions with respect to exemption. For example, you have to apply the income of the non-profit organization for the charitable purpose. If you do not apply for charitable purpose in India, if you apply it for the benefit of a specified person, related person, then the income will be taxed in that year. Or if, let's say, for example, you have income of the not-profit organization, which is exempt. But if you fail to apply for the charitable purpose, yet you have accumulated the income, but you fail to apply for the specified purpose, then it will be considered to be the income of the previous year in which the violation occurs. Now, the income was exempted in the 1961 Act because it accrued prior to the 2026. But you have violated the condition in this year, after 2026. So now, under the old Act, obviously this would have been considered as the income of the previous year 26-27, but old Act is not there. So you cannot say under the new Income Tax Act also you cannot charge. No. This will be deemed to be the income in the new Income Tax Act only. Okay. Then any sum payable under the repealed Income Tax Act may be recovered under this Act without prejudice to any action already taken for the recovery of such sum under the repealed Income Tax Act. If any income tax is payable by you, you are not paying it, the recovery proceedings can start under the new Income Tax Act also. Okay. Any agreement entered into, appointment made, approval given, recognition granted, circular, direction, instruction, notification, order, rule, or any scheme framed thereunder issued under the provision of the repealed Income Tax Act shall, so far as it is not inconsistent with the corresponding provisions of this Act, be deemed to have been entered into, made, granted, given, or issued under the corresponding provision of this Act and shall continue in force accordingly. So if any circulars, notifications are issued in the old Income Tax Act, because under the new Income Tax Act, they have not yet issued the fresh circulars. Any directions given to the income tax officers by CBDT, any approval given to, let's say, the charitable trust for the exemption will be continued to be applicable under the new Act also if the objective that it was, let's say, circular trying to explain, notification issuing something is same as the new Income Tax Act, then it will also apply to the new Income Tax Act. Okay. Where the period provided for any application, appeal, reference or revision under the repealed Income Tax Act had expired on or before the commencement of the new Act. So there are time limits to file the appeal. There are time limits to file the applications, revision application. But this has expired before the Income Tax Act 2025 came into picture. Then nothing in the new Act shall be construed as enabling any such application, appeal, reference or revision to be made under this Act by reason only of the fact that a longer period therefore is prescribed or provision is made for extension of time in suitable cases by the appropriate authority. So if the time limit for filing any appeals have expired in the new Act, in the old Act, you cannot say now in the new Act, if there is an extended timeline given after 1st April 2026, I will go as per the new Act and let me file the appeal. In the old Act, the time limit had expired for you. So this new Act will not create a fresh timeline for you. It has expired, you will not be allowed under the new Act also. Okay. Any amount of credit in respect of tax paid allowable to be carried forward in the case of an assessee under the provisions of 115JAA or 115JD of the repealed Income Tax Act for tax year beginning before the 1st April 2026, had the Income Tax Act not been repealed, so any MAT or AMT credit which was there in the old Income Tax Act shall be deemed to be the amount eligible for credit under the corresponding provision as the case may be in the case of said SSC under 2063 or 4. So whatever MAT credit, AMT credit that was there, that will not lapse for you under the new Act. Now under the new Act, you will get that MAT or AMT credit under new section. But the credit for that tax paid under the repealed Act shall be allowed under this Act for the period for which it would have been allowed under the repealed Income Tax Act if the assessee otherwise continue to satisfy the condition as specified in corresponding provisions or section 2063 or 4 of the Act as the case may be in such tax year. So essentially, you will get the AMT or MAT credit, that period which is there, you will get only for that period. You cannot say I have claimed for 15 years in the last particular period. Now again give me the fresh period in the new Income Tax Act. No, you will be allowed for the remaining period only. And subject to the satisfaction of the conditions, if any, laid down under this provision. If you fail to satisfy the conditions, then obviously you will not get the AMT or MAT credit. Any amount of loss under the source or head of income specified in column B of the table given below and referred to in the section of the repealed Income Tax Act specified in column C of the said table, brought forward for the tax year beginning before the 1st April 2026 had the Income Tax Act been not repealed, shall be set off and carried forward against the income computed under this head in the manner provided in the respective section of the repealed Income Tax Act specified in column C of the said table for the tax years beginning on or after 1st April 26. So if you have any losses, that will not lapse under the new Act, you will be eligible to carry forward and set off those losses under the new Act, but the time limit for those losses shall be same as what was given in the old income tax. So income from house property loss, PGBP loss, speculation business loss, specified business loss, activity of owning and maintaining race horses loss. Now these will be carried forward and set off as given under this particular sections. Are we clear? Any amount of loss under the head capital gain, any capital loss, whether long term or short term, referred to in section 74 of the 1961 Act, which is brought forward from the tax year beginning before the 1st April 2026, had the Income Tax Act not been repealed, shall be carried forward and set off in accordance with the manner provided in the section 74 itself against the income under the head capital gain computed under this Act for any tax year beginning on or after 1st April 26 up to 8 financial years immediately succeeding the financial year in which such loss was first computed under the repealed Income Tax Act. So, any capital losses which are claimed, brought forward, will be carried forward here and you can set it off against the income for 8 assessment years. Any set off of loss or allowance for depreciation, any unabsorbed depreciation, which is claimed before 1st April 26, in the hands of the amalgamated company, successor company or the successor LLP in accordance with the provision of section 72A of the old Income Tax Act shall be deemed to be the income of the amalgamated company, successor company or the successor LLP chargeable to income tax under this Act for the year in which any of the conditions specified in that section are not complied with. So the amalgamated company, the LLPs or the successor company can claim the losses of the amalgamating company, right? But there are certain conditions with respect to it. On the conversion of company to LLP, on the conversion of partnership firm to company, the losses can be claimed of each other. But there are certain conditions with respect to that, amalgamated company should be engaged in the business for specified years. There are conditions for the amalgamating company. So if any of those conditions are not complied with, And in the 1961 Act, you had the loss. The amalgamated company was carrying that loss. In the new Income Tax Act, you have violated the conditions which were given. So this will be considered to be the income under the new Income Tax Act. Okay. Any set-off of accumulated loss, unabsorbed depreciation allowed in any tax year beginning before 1st April 2026 to the successor cooperative bank in accordance with the provision of 72A shall be deemed to be the income of the successor cooperative bank chargeable to tax under this act for the year in which any of the conditions of that section are not complied with. So similar to the amalgamated company carrying forward the losses of amalgamating company, the LLP which is converted from company, the company which is converted from partnership firm or sole proprietor, right? Similar to that, there were also conditions for the cooperative bank amalgamation. So if those conditions of section 72A just like not complied with in the 72AB also, then that will be considered in the income of the new Income Tax Act. Okay. So even though you had the losses accrued you could carry forward in the new Income Tax Act. But if the conditions of those earlier sections are at any point violated because you had the permission to carry forward those losses in those particular sections, subject to the fulfillment of those conditions. If you fail to fulfill the conditions of those sections, now those conditions may have been changed today in the new Income Tax Act. But because you had the accrued benefit in that particular section, the benefit accrued to you on subject to the satisfaction of conditions. So if you violate conditions even today, so then it will be considered as the income in the new Income Tax Act. Similarly, any profit or gains arising from the transfer of capital asset not charged under the head capital gain by virtue of exemption under 47(4), 5, 13, 13B, 14. These are in relation to the transfer of capital asset by a holding company to wholly owned subsidiary or vice versa. Amalgamation, right? Demergers. So again, that was subject to fulfillment of certain conditions. Now, you had that exemption under the old Act. Now, in case for the tax year in which transfer took place, if any of the conditions are satisfied or in which any of the conditions are not complied, then this will be charged in the new Income Tax. Are we clear? Where any allowance or part thereof under 32(2), 35(4) of the repealed Income Tax Act is to be carried forward to the tax year beginning on the 1st April 26. Unabsorbed depreciation, unabsorbed scientific research expenditure, that shall be added to the amount of capital allowances referred to the corresponding provisions of the Act for the tax year beginning on 1st April 2026 and deemed to be part of that allowance, or if there is no such allowance for that tax year, be deemed to be the allowance for that tax year. So any unabsorbed depreciation, unabsorbed scientific research expenditure will be allowed to you in the new Income Tax Act also. The deductions referred to in these section, right, or 3619 for family planning of the repealed Income Tax Act shall on the fulfillment of the conditions mentioned in the said provision continue to be allowed under this Act for the tax year beginning on or after 1st April 26 had the Income Tax Act not been repealed, and such deduction shall be added to the amount of deferred revenue expenditure allowance referred to corresponding provisions of this Act for the tax year beginning on or after 1st April 26 and deemed to be part of the allowance, or if there is no such allowance for tax year, be deemed to be the allowance for that tax year. So if there are any sort of these deduction, telecom, spectrum license, the unabsorbed preliminary expenses, right? The voluntary retirement deduction, expense deduction. So these sort of deductions are available for a period of many years. These are not available for only 1 year, right? So if you had claimed any of that, for example, family planning expense, it is available for 5 years period, right? So these, if you had claimed in the earlier Act, then subject to the fulfillment of the conditions given in those sections, these will be allowed to you in the new Income Tax Act also. Right? Then credit balance in the provision for bad and doubtful debts account made in 3617A of the repealed Income Tax Act standing on the last day of the tax year beginning on 1st April 2025 shall be added to the amount credited to the provision for bad and doubtful debts account referred to in the corresponding provision of this act for the tax year beginning on or after 1st April 26 and deemed to be part of the amount credited to the provision for bad and doubtful debts account. So any credit standing in the PFDD account will be taken in this particular act also. Any scheme which has been notified under the provisions of the repealed Income Tax Act with a view to eliminating the interface with the assessee or any other person, the said scheme shall be deemed to have been made under the corresponding provision of this act or under section 532 where there is no such corresponding provision and shall continue in force accordingly. For example, for assessments for appeal, faceless schemes have been notified. Right? So those schemes will not be again notified here unless they want to change something. So whatever are notified, those faceless schemes are notified in the old Income Tax Act shall also be adhered in the new Income Tax Act. It will not be the case that now the assessments will be made by the officers, but physically. It will still be faceless. Where a search has been initiated under 132 or requisition is made under 132A prior to the commencement of this act, the provisions of the repealed Income Tax Act shall continue to apply to any proceedings connected in respect of such search or requisition as the case may be, as if this act is not enacted. So, if any search or survey operations or requisition operations have been initiated before the commencement of this act, these will continue to apply. Those provisions only will continue to apply because it pertains to that particular period. Similarly, when any reference is made in this act to any tax year commencing on the 1st April 2025 or to any earlier tax year, the same shall be construed as a reference to the corresponding previous year under the repealed Income Tax Act. Because the Income Tax Act 1961 was applicable to previous year 25-26. The Income Tax Act 2025 is applicable to tax year 26-27. So, for the tax year 1st April 25 means 25-26 tax year means the previous year 25-26. Are we clear? So, this is the transition mechanism which has been given under section 536. And this is very, very important for the parallel operation of the two acts. So, this ensures the continuity of the old Income Tax Act parallelly with the new Income Tax Act. Are we clear? So I think with this, let us take a break of 10 minutes and then we get back. Yeah. So let us get back, students, with respect to the topic now after 5:36. So now we are going to discuss about how do we interpret the Income Tax Act. So there are, general interpretation rules that the court uses in terms of how does one interpret the law, not just the income tax law, right? So essentially, we have to use the same principle because income tax is also a law. So rules of interpretation that are applicable with respect to the interpretation of any law will be applicable over here only. So what are the rules of interpretation? Literal interpretation, which is, the first thing that you need to do is always look at what is the act saying. Like look it at literally. So when you read the words, you may find the intention from the words itself, right? So that is the rule of literal interpretation. The second is obviously if the reading of the text of the law does not give you an answer, the meaning comes out is ambiguous, right? Then you should look at the purposive rule, basically, right? Which is the golden rule, right? Which is called the golden rule. So basically, when you do not understand from the law itself what the text is saying, you go as per the, or when you do not find the meaning through the ordinary words of the text of the law, you go as per the intention of the law, right? So in that particular case, you will go and find out the context in which a provision was introduced. So how do you understand the context of the provision? The context of the provision can be understood in the way that how the particular or why the particular section was introduced. Right? Why a particular section was introduced at the first place. That's how you will understand the context of the particular provision. Now, where do you get the context of the provision? How will you understand why a particular section was introduced? You go to the memorandum to the finance bill. You go to the notes to the finance bill. Right? So basically, whenever a provision is introduced in the finance bill, so in that particular case, what happens is that the memorandum is also introduced simultaneously. The memorandum is also introduced simultaneously, which gives you the understanding of that why a particular provision was introduced at the first place. So that will help you ascertaining the context of a particular provision. That is called as the golden rule. Because if the literal interpretation does not give you the correct answer, then you apply the golden rule. So first thing is that you always apply the literal interpretation of the act. If that does not give you any correct answer, then you go as per the golden rule. Right? So basically, the golden rule is that you look at the context of the Income Tax Act. So golden rule is to read the section as a whole. You look at what the section is saying in entirety. Are we getting this particular point? So these are the rules of construction. So, for example, if the object of the section is not coming into, right? For example, if let's say for example, the act is saying something, but the object is not very clear. You're not able to ascertain what the act is trying to say at the first place. Are we getting it? So in that particular case, you adopt this particular kind of rule. Are we clear? Then you have something called as the mischief rule, or which is also called as hidden rule, which is again a purposive construction. in that particular thing, you identify that what was the provision before the amendment and what this amendment is trying to rectify. What was the mischief in law that the amendment is trying to rectify? So you identify that. And then based on that, you understand, okay, this is how the provision has to be understood. Then you have something called as rule of or principle of beneficial construction. That if there are two views possible to a particular provision, you adopt the view which is more beneficial to the taxpayer. You have rule of harmonious construction, that the statute must be read as a whole. All the parts of the section should be read harmoniously. Right? You need to read the proviso explanation harmoniously with the provision of the section. Obviously, now those are not there in the new act. Then you have something called as rule of adjustum generis, which is the, if you are trying to interpret a word, you need to understand the meaning of the term from the neighboring words. Right? So let's say, for example, if it talks about the definition of intangibles, it says goodwill, trademark, or any other right of similar nature. So now, any other right of similar nature, you have to understand the particular words are pertaining to the class of intangibles. Right? So any such sort of right, tenancy right, licenses will also be intangible. Similarly, you have a principle of nociter assisis, which means that a word, but when you are interpreting a term, for example, professional technical consultancy services are called the fees for technical services. Now, what is technical? So the Supreme Court interpreted the term technical to mean that it derives a color from professional and consultancy. It will not include any automated services. It will only include services where the human intervention is there, because for professional and consultancy, human intervention is required. So automated services cannot be technical services. There has to be some sort of human intervention. That is the principle of nociter assisis. Right? So these are some of the interpretation principles that one need to apply to interpret the act. And the courts, by and large, look at these particular principles to understand the act. Right? Now, coming to the interpretation of different provisions of the Income Tax Act. You have the charging provision. Now, charging provisions are basically that tax is levied by a charging provision. A charge is created. So, if the charging provision is introducing a liability, right, it is creating a charge, that has to be interpreted very strictly. So, a literal interpretation has to be applied. A strict interpretation has to be applied. You cannot say that, or you cannot understand it very loosely. You have to go by the exact wording of the law. You cannot apply the purposive interpretation over there. Why we cannot apply the purposive interpretation over there? Because the charging section is the most important section creating the charge. Right? It cannot be drafted loosely or understood loosely. So that has to be understood literally by giving the words their ordinary, natural, and grammatical meaning. Are we clear? So that is about the charging section. The machinery section, which are basically to make the Income Tax Act workable. For example, return filing, the assessment provisions, the TDS provisions. Those are machinery provisions. Okay? So machinery provision should be interpreted liberally. A liberal interpretation needs to be adopted. Unlike charging provision where you apply a strict interpretation, a literal interpretation, in machinery provision you apply liberal interpretation and a purposive interpretation. For example, if you see in many of the cases where, example, let's say, to claim the concessional tax regime, you should file the form on or before the due date of filing return of income. To claim certain deductions, you need to file the forms before the due date of filing return of income. Now, in those cases, these are machinery provisions. File the form for election, right? So the courts, the tribunals in many cases have understood that even if for certain reason the assessee was not able to file it because of certain reasons which were beyond his control, then the machinery provisions are not to be interpreted in such a way that the benefit will be denied to the assessee just because he didn't file the form. The machinery provisions are to be construed in a way so that it makes the machinery workable rather than rendering it useless. So they are to be interpreted liberally, and the courts have granted them extension that okay, if they file later, that is fine. That will not deny them any benefit. Right? Penal provisions. Again, the penal provisions, because they are imposing just like charging provision, some penalty, they are to be construed in a strict manner. So you cannot understand it very liberally and say, okay, I will charge penalty on everybody. So in case there is some sort of ambiguity, the taxpayer should be given a benefit of doubt that the penalty is not applicable. Right? Deeming provision, which deem to accrue or arise in India, which deem that the income is taxable. Again, these are the chargeability provision, right? Because these are enlarging the scope of income. So deeming provision, just like charging provision, have to be strictly construed in a literal manner. Appeals and refund provision. Again, these are just like your machinery provision. These should be liberally construed. If somebody has failed to file the form within the 30-day prescribed limit, let's say, for a filing of appeal, the provision should be construed liberally. He should not be denied the benefit of going for the appeal altogether. Similarly, any sort of exemption and relief provision should be again liberally construed. So any exemption, deduction which are given to you, they should not be strictly construed. If you satisfy the conditions more or less, you should be given the benefit. If you have just not filed the form, you should not be denied the benefit of the deduction altogether. Right? So these are certain broad level principles that one takes into consideration while interpreting the act. Now, when you interpret the act, as I said, first of all, you need to understand the act as is. Right? You need to give the literal meaning. And only when the meaning is ambiguous, then you go for the purposive interpretation. For purposive interpretation, what do you need to refer? You need to understand the context of introducing a particular section. Now, how do you gather the context? As I said, you look at the legislative history, what was prior to that particular section, and what that section is trying to rectify, what that amendment is trying to rectify. Right? Hayden's rule. So you look at the Law Commission report, committee report, for example, the recent new Income Tax Act. Now, when the Income Tax Act came as a draft provision, there were many things which were different than what you have in the final Income Tax Act. So in the draft Income Tax Act 2025, there were certain different things. So when you are going to interpret the Income Tax Act 2025, you are going to look at the draft Income Tax Act and see, okay, in the draft Income Tax Act, the provision read like that. And in the new Income Tax Act, that has been changed. So that amendment is intentional. The act was intentionally modified to remove that particular point from draft. You look at the Law Commission report. The Law Commission report or the parliamentary committee in this particular case also, in the case of the new Income Tax Act also, the entire answers were given on the comments that were given for the draft rules. So for the draft rule, they came up for the public comments. Right? So basically, the parliamentary committee was formed for the new Income Tax Act, which gave its input that, okay, this is what is put under the new Income Tax Act for this particular purpose. So, to understand the provision in the new Income Tax Act, you have to read that select committee report on the Income Tax Bill 2025. So, that will give you an idea, okay, why this particular wordings are like this in the new Income Tax Act. You have to also look at the old Income Tax Act to see, okay, the old Income Tax Act wordings were like this, the new Income Tax Act were wordings like this. So this change is intentional because the new act is just trying to consolidate everything. Right? it has not intended to make an amendment. So if this amendment is made, this is made with an intention, right? So you have to look at all these external material when the words of the text of the law are ambiguous. You have to look at the finance minister's budget speech to understand why she introduced a particular provision. You have to look at the explanatory memorandum, but all of this extrinsic material you will refer only when the text of the law is not very clear. Okay. Now, one more important point, when you are referring to the act, there are certain non-obstant clauses. What are non-obstant clauses? These are the notwithstanding clause. So whenever the wordings of the law start with notwithstanding anything contained in the any other provision of the act. This was there in the Income Tax Act 1961. Now in the Income Tax Act 2025, they are using the language irrespective of anything to the contrary contained in this act. So whenever the wordings used are irrespective of anything to the contrary contained in this act, in the 1961 Act, they used to put the non-obstant clause as notwithstanding. Here they have replaced notwithstanding with irrespective of. So the irrespective of essentially means that this is a non-obstant clause, which means it is overriding the other provisions of the Act. It is going to have an overriding effect in case of conflict over the other provision of the Act. Are we getting this? So, it will override the other provisions of the Act. For example, if you look at, there is in the PGBP a section on the deduction on payment basis. So, otherwise you have deduction on the accrual basis. But there is a particular section which says that there is a deduction on payment basis. So, irrespective of anything contained in any other provision, these particular expenditures will be allowed only when you make the payment of that. Now, it starts with a non-obstant clause. So, essentially it means that it will override all the other provisions of the law. Or all the other provisions of the Act. Are we getting this particular point? So, for example, you will have certain other provisions which will talk about that this will apply in this particular situation only. So in case of any such sort of conflict, right, you will have the provisions applicable in that particular way only. Are we getting this point? So in that case, the irrespective of, for example, let me show you one provision, the provision that I was talking about, so you will understand it better. This is my Income Tax Act 2025, sorry. Section 37, deductions allowed on actual payment basis. What does it say? The sum payable as specified in subsection 2, which are otherwise allowable as deduction under this Act, on the accrual basis, obviously. The deductions are allowed, the expenditure is allowed on accrual basis, shall be allowed as a deduction while computing the income chargeable under Section 26 only in the tax year in which such sums are actually paid, irrespective of any provision to the contrary in this Act. So if, let's say for example, the section, for example, any other section is providing that the deduction for, let's say, interest on loans will be allowed on the accrual basis. So let us say for example, that if I go for this particular section, one second. (32). 32B says interest paid in respect of capital borrowed for the purposes of business or profession. This will be allowed as deduction. Now this is allowed as deduction on the accrual basis. But your 37 is saying that irrespective of any provision to the contrary. Now, even though 32 is saying that the interest will be allowed as deduction in the year in which it is incurred, but 37 is saying that the interest on loans or advances or borrowing from specified financial entities shall be allowed only on the payment basis, only in the tax year in which such sums are actually paid. So irrespective of any provision to the contrary in this act will override all the other provision, will override section 32 also. Are we clear? So the irrespective of is essentially the non-obstant clause. Are we clear? So whenever you are reading any non-obstant clause, you have to be sure that it has to be read in line with the other provision, means it's going to override the other provision. It is going to override the other provision. Okay. So that is something that you need to keep a note of. Second, any definition clauses which are there, again, those have to be read in the literal manner because they are defining something. They cannot be read liberally. Are we clear? So definitions are given in section 2. These are also given in the particular chapter also. So every chapter, every head of income have its own interpretation section which consists of the definition relating to that head of income. So if I have to show you again, let me go back to show you actually the layout of the new Income Tax Act. So if you see here, this is what we were talking about PGBP. It has the interpretation over here at the end of it. See, section 66. This will consist of all the definition for the purposes of part D of this chapter. Everything is defined over here. Right? Similarly, you will see for this is the basically, if you look at the income from house property, section 25 consists of the interpretation. Right? So here again the definitions are given over here. Similarly, if I go for the capital gain, so here also you will see at the end of it that meaning of the adjusted income, cost of improvement, everything is put over here. Right? So there are the sections similarly for TDS also. The definitions of all of that are given in the interpretation chapter. Right? So in that particular context, so if I to show you for that particular, let's say TDS, because again that is something, you will say that where these professional services or all of that is defined. So you will find that in the interpretation. So if you see here, the interpretation is given. 1 second. Section 402. So if you see here, agriculture land for the consideration, all of that is defined over here. Right? So essentially the broad layout of the new Income Tax Act is that is very similar to the 1961. So you have the computation mechanism, you have the basically clubbing of income, set off and carry forward of losses. All of that is kept same. It is just the structural change that has taken place. Okay. Now, moving towards the charge of income tax, which is very, very important. So let us go back to the charging section of the income tax. So if you see chapter 1, which is preliminary, it talks about the short title, extent and commencement. And chapter 2 of the Income Tax Act talks about the charge of income tax, which is given in section 4. So this is the charging section. It creates the charge on income, basis of charge of income tax, if you look at the heading. So 4.1 says, where any central act enacts that income tax shall be charged for any tax year at any rate or rates. Where any central act enacts that income tax shall be charged for any tax year at any rate or rates. Income tax for such tax year shall be charged at that rate or those rates in accordance with and subject to the provisions of this Act. Okay. So let us understand this first, the 4.1. Let me talk about this particular provision. So, one second. So, if I have to talk about this charging section, just a second. Okay. I hope the screen is visible to you. Yeah. So, if I have to talk about this particular provision of this 4.1, it says where any central act, okay, where any central act which is there, which is enacting that income tax shall be charged for any tax year. Now, what do we understand by the central act over here? What do we understand by the central act over here? What is central act? The central act over here essentially means my ITA or Finance Act. So, my central act here means the Income Tax Act or the Finance Act. So, where any central act is enacting that income tax shall be charged for any tax year. So, income tax shall be charged for any tax year. Now, if you look at it, the tax year is defined, and which is what we are going to see later. So, where any central act enacts that income tax shall be charged for a particular year, for any tax year, at any rate or rates. Okay, at any rate or rates, then the income tax for such tax year shall be charged at that rate or those rates in accordance with and subject to the provisions of this Act. So if the Finance Act is saying, if the Central Act is saying that the income tax shall be charged for any tax year at the rate or the rates. Now, how do we get the rate or the rates? So, the income tax rates which are there are given in the either Finance Act or in the Income Tax Act. Right? So, income tax rates are given where? In the Finance Act or in the Income Tax Act. So, the Finance Act which is there, the Finance Act which is there will be giving you the general rates of taxes. Right? The Finance Act is going to give you the general rate of taxes. The Income Tax Act which is there, that will give you the specific rate of taxes. Are we getting this particular point? So, in the Finance Act, where do you find the income tax rates? So, in the Finance Act, you find the income tax rates in the Schedule 1. In the Schedule 1, right? As I told you, in the Schedule 1, there are 3 parts which are there. Part 1, Part 2 and Part 3. So there are 3 parts in the Finance Act basically. Okay. Now, if you talk about the Part 1 which is there, So the part 1 to the Finance Act which is there, that is giving you the tax rates which are there for the current tax year. Which means the part 1, basically this year they have divided 1A, 1B because you also had the old Income Tax Act which was there, isn't it? So in the Finance Act, if you talk about, so you have part A, right? So in the part 1A or part 1B, you have the rates of the current year. So current tax year means which year we are talking about? 2026. In the part B or part 2, you have the TDS rates for the current tax year, which is 2026-27. And in the part 3, which is there, in the part 3, which is there, you have the tax rates for deducting the income chargeable under the head salary and computation for the current tax year, which is 26-27. Now you will say, ma'am, what is the difference between part 1B and part 3? See, the part 1 which is there, it used to cover the rates of the tax for the assessment year. Okay. So part 1, if you look at it, that's why you have 1A and 1B. It is for the assessment year. But now the assessment year is tax year only. So these are going to be the applicable for the current assessment year or the current tax year. So basically for the purposes of self-assessment taxes. Part 2 is for TDS. Part 3 is for the advance tax, which is for the next tax year or for the current tax year only, but for the purposes of advance tax. So part 3 used to be for the previous year. But now everything is tax year. So therefore you don't have the separate ones. Are we clear? Okay. So essentially, what does the Income Tax Act is telling you? The Income Tax Act is telling you, Section 4 is telling you that where the Central Act, which is Income Tax Act or the Finance Act, is enacting a tax that shall be charged for any tax year. That shall be enacted for particular tax year. Then in that particular case, the income tax for that tax year shall be charged at the rate either given in the Finance Act or in the Income Tax Act. So either you will apply the general rates or you will apply the special rate which are given in the Finance Act or in the Income Tax Act. Are we getting this particular point? But this shall be subject to the provisions of this particular act. This shall be subject to the provisions of this particular act. So now understand one particular thing. So in this particular thing, what you need to understand is that the computation of the income is subject to the taxes are subject to the provisions of this act. That basically the act will override over the Section 4. If the act is providing you something, then Section 4 is subject to that. Okay. Are we clear about this? Yes. So essentially, you have to understand the charging section, as I said, in a very, very literal manner. Right? You have to understand this in a literal sense. You cannot be understanding it very liberally. Okay? So let us just write about it. Let me just share the screen. So here the Central Act, which is there, refers to the Finance Act or Income Tax Act, right? Shall be charged for any tax year or at any rate. So your rates will mean under the Finance Act, my general rates, or under my Income Tax Act at the special rates. Okay. So under the special rates, you have, for example, the specific tax rates on, let's say, long term, short term, right, etc. Under general rate, if I talk about, as I said, you have part 1B. This is in the first schedule to the Finance Act, right? Part 1B talks about the tax rate for the tax year, right? Part 2 is your TDS rate for the current tax year, and your part 3, which is there, is your advanced tax rates for the current tax year. Okay. Now what does section 2 says? The charge of the income tax under subsection 1 shall be on the total income of the tax year. Now what do we understand by the term total income? Is total income defined? Yes, total income has been defined. Where is the total income defined? Let us go to the, again, back to the Income Tax Act. So this is my Income Tax Act. Section 2, definitions. You have 107. Sorry, 108. Total income means the total amount of income referred to in section 5, computed in the manner laid down in this act. So, if I again take you back, right? So here, if I talk about give me a minute. Yeah. So here, my total income means, so total amount of income, right? So if you look at it here, again, when I talk about, it refers to the total amount of income, right? It refers to the total amount of income. So when I talk about the total amount of income, what is income? The charge of income tax shall be on the total income. Now total income here means as per section 2108. Right? This means as per section 2108. But when I go to 2108, what is 2108 saying me? That it is the total amount of income. So total amount is again of income. The income is not defined here. So for that, I need to go to the definition of the income. So where is the income defined under the Income Tax Act? Again, under section 2 itself. The income is defined under the section 2, which is defined under which particular section of 249. So here total amount of income which is there, this is defined in 249, definition of income. So total amount of income includes, it's an inclusive definition, meaning one can understand it to include many things beyond even listed. So there is a difference between inclusive definition and exclusive. The exclusive definition starts with means, which is a very restricted definition. You cannot add anything more to it. The inclusive definition you can add even beyond what is said. So total amount of income referred to in section 5. What is section 5? Scope of total income. My section 5 is scope of total income. Okay. So this is the definition of income, which is inclusive. The scope of total income talks about the determination of what will be included in my total income based on my residential status. So this is decided based on my residential status. Computed in the manner as laid down in this act. So when I talk about the computed in the manner as laid down in this act, means refer to the computation provisions. So I need to refer to the computation provision, which is basically chapter 4, chapter 3, chapter 5, all of those. Right? So I need to take into consideration that what is chargeable under the head salary will be defined by the salary charging section of that. So it has to be computed in reference to those sections only. So computed as per the manner laid down in this act. What is PGBP? It is defined by charging section of PGBP. Are we getting it? So the charge of the income tax under subsection 1 shall be on the total income of the tax year of every person. Of every person. As per the provisions of this act. So the total income, the charge of the income tax under 1 shall be on the total income of the tax year of every person as per the provision of this act. Now, what do we understand by person? So again, person is defined under section 2. So the person which is defined under section 2 is, it includes, or it basically the person which is there, it refers to the different category of the person. It includes individual, HUF, company, firm, AOP, BOI. It is defined in So, section 277. So what does section 277 says? The person includes all of this. I'm just copying here for your ease. So, sorry. Person includes an individual, HUF, a company, a firm, AOP, BOI, every local authority, artificial juridical person. Again, this is an inclusive definition. So this is my section 277. Okay. So the total income of the person. So if you remember at the start, I told you the direct tax is on the income of a person. Right? So the total income of the tax year of every person, as per the provisions of this act. Now, tax year again, where is it defined? It is defined in section 3. So, if this is section 3. What is the meaning of the tax year? Section 3 defines the tax year as so it means for the purposes of this act, tax year means the 12 months period of the financial year commencing on the 1st April. In the case of a business or profession newly set up or a source of income newly coming into existence in any financial year. So if the business is newly set up, it comes into existence, let's say, mid of the year. Then how can you consider the tax year from the 1st April? Because the business was not in existence. So the tax year shall be the period beginning with the date of setting up of such business or profession, or the date on which such source of income newly comes into existence and ending with the said financial year. So that is the meaning of the tax years. Okay. So 4.1 is saying where the Central Act, which is Income Tax or Finance Act, is enacting that the income tax shall be charged for any tax year at the rate which is given in the Finance Act or Income Tax Act. Then income tax for such tax year shall be charged at that rate or those rates in accordance with and subject to the provisions of this Act. The charge of the income tax under subsection 1 shall be on the total income of the tax year. Right? So we understood what is the meaning of the total income. What is the meaning of the tax year? Of every person. So the income tax will be charged by the Finance Act or the Income Tax Act. The rates will be given in the Finance Act or Income Tax Act, which will be charged on the total income of earned by whom? By the person. When? In the tax year, as per the provisions of the Act. Then subsection 3 is just clarifying income tax shall also include any additional income tax by whatever name called levied under this Act. So it will include additional income tax means what? The additional income tax is generally, for example, surcharge. Surcharge is considered as the additional income tax. Right? So income tax will also include the surcharges. If this act provides that the income tax is to be charged in respect of income of a period other than the tax year, it shall be charged accordingly. So there are exceptions to the rule of the tax year, that the income of the tax year shall be charged in the next tax year, right? So obviously there are exceptions to that. So if there are certain exceptions, then as per that, the income is not necessarily to be charged in the tax year itself. It can be charged in as per those provisions. Right? So we are going to look at that as well. So as I said that the 4.2 is clearly telling you that the income is to be charged on the total income of that particular tax year itself. But this is clearly telling us that the income tax, if the act provides that it is to be charged in some other period other than the tax year, then in that particular case we will consider that. So that is an exception to the general rule that the income of the tax year will be considered. Are we getting this particular point? So that is our 4.4. And last 4.5 is saying for the income chargeable under this section, income tax shall be deducted or collected at source or paid in advance as provided in this act. Now what does that mean? So this is just a mechanism to collect the tax. Right? So this is just a mechanism to collect the tax. So it can be collected by way of self-assessment tax. It can be collected by way of the TDS, by TCS, or by the advanced taxes. So for income chargeable under this section, income tax shall be deducted or collected at source or paid in advance as provided under this act. So howsoever the mechanism is provided under the machinery provision, that way will be applied. Now coming to the 4.4 back. This is saying if this act provides that income tax is to be charged in respect of income of a period other than the tax year, it shall be charged accordingly. So the general rule, as I said, what is 4.2 saying? Total income of the tax year. So income of the tax year is going to be assessed after the end of that year. Right? So it will be assessed in that particular tax year itself. However, there are certain exceptions to that. And those exceptions are given in certain sections. So what are those exceptions? Let us understand that. So income of the or income earned in the tax year shall be charged, right? Now what are the exceptions in relation to that? Let us understand. So first of all, for the shipping business of non-resident. Section 316. So what does this provide? So where a non-resident is having a ship, right? And generally what happens is that when they are going to leave the port, right? So when a non-resident ship company is carrying any, either it's a passenger ship or carrier ship, whatever, right? So now they may come to India, right? And they have made this income from the sale of tickets or, sale of or the carriage of goods they have on for the storing the goods and bringing the goods to a port in India, right? Now, obviously, once they leave India, will the income tax ever be, or income tax department will ever be able to collect the taxes, because they may come for once only. They may not come again, right? So that is the reason why what, the law says is that before they leave the port in India, the ship is allowed to leave the port in India only when they make the payment of the taxes. So if they do not make the payment of the taxes, they are not allowed, or they are not giving the tax clearance certificate. So they can only leave the Indian port once they get the tax clearance certificate. So this is the section which is saying that the tax of the income of the tax year shall be charged in the same tax year. So these exceptions are saying that the income of the tax year shall be charged in the same tax year. So shipping business of non-resident. Second, person leaving India. Section 317. So if an individual is leaving India and the AO thinks that he has no intention of returning to India, then in that case the total income of that individual for that tax year up to the date of his departure will be taxed in the current tax year itself, because the AO fears that he may never come back. He's going to flee from India. So in those cases also the tax is levied in the same year. Third is AOP or BOI formed for a particular event or a particular purpose. So where it is common that to carry out these contracts, to undertake any sort of joint ventures, the entities or the people usually form the AOP or BOI for a specific purpose, right? So once that purpose, once that contract, once that agreement is over, the AOP may get dissolved. So in that particular case where the AO thinks that it is going to be dissolved, then the total income of the AOP will be taxed up to the date of dissolution in that tax year itself. So in case of, let's say for example, a contract for a road, a contract for, let's say, any turnkey project to build a particular building, and AOP is formed by two partnership firms. So AOP will be dissolved after that completion of building. So in that case, the income earned in that year will be taxed during that year itself. Next is any person who is likely to transfer the property to avoid the tax. So first of all, this was section 318. Likely to transfer property to avoid the tax. 319. So if the AO thinks that there is a person who is likely to sell his property because there is some income tax recovery going on against him, or he has an idea that the income tax outstanding was there and the recovery may be made. So in case of that such person, the AO up to the date when the proceedings get commenced under this particular section, the income of that year will be charged in that particular year itself. Similarly, the last one is discontinued business. So these are the 5 exceptions which are there. C20. So where business is discontinued, then the income of the period beginning from the first day up to the date of discontinuance may be charged in that particular year itself, because now the business is discontinued. So if you see this section 316 to 320 provides for the exception that the income of the tax year shall be charged to income in that particular income tax in the same tax year. So that's what our 4.3 is saying, or 4.4 is saying, that if the Act provides that income tax is to be charged in respect of income of a period other than the tax year, it shall be charged accordingly. Right? So the 4 is putting you or subjecting you to the balance provisions of the Income Tax Act. So you have to read holistically your Income Tax Act. So again, just quickly summarizing the section 4, because this is the most important section, because this is creating a charge. The income tax shall be charged at the rates which are specified either in the Finance Act, which are your general rates given in part 1B for the current tax year, part 2 for TDS, and part 3 for the advance tax of the tax year. Or under the Income Tax Act, specified rates are given. then the income tax at that rate will be charged on the total income. What is total income? It is defined in 2108 as total amount of income. We are going to look at the definition of income. Referred to in section 5. What is section 5? Scope of total income, which is going to define what is your income chargeable to tax in India based on your residential status. Computed in the manner laid down in this act. So total income, the income is to be computed as per the charging provisions of each head of income, the clubbing, the set off carry forward, the deductions, all of that needs to be taken into consideration. Right? So first of all, to compute your total income, you will go to section 5, what is included in my scope. Then you will look at chapter 3 of the Income Tax Act, income which do not form part of total income. So it will never enter your total income. Those are exempt income. You will look at each head of the income, salary, PGBP, IFHP, IFOS, capital gain, right? Clubbing of income. Then you will look at set off and carry forward of losses. Right? So after that, you will look at your deductions chapter. Rebates and relief, right? So all of that have to be combined, look into, because it is to be computed as per the manner laid down in this act. And this has to be the total income of the tax year. We have understood what is tax year defined in section 3. Of every person also we have looked at, 277, as per the provision of this act. Now let us quickly look at just the definition of the income. We'll just quickly glance through it. It's a very inclusive definition, as I told you briefly. Let me take you to the Bare Act. Right, so this is my definition of income, which is given, one second. Yeah, 249. Income is defined, as I told you earlier also, in an inclusive manner. Right, it is defined in the inclusive manner. So it will include much beyond what is included also, because it can include anything, right? So it is defined in an inclusive manner to include what are the kinds of income: profit and gains, dividend, voluntary contributions, perquisites, special allowances or benefits, right? This is for the salary, right? For the head of the salary, these are particularly given, the perquisites and benefits, right? So any allowance granted to meet the assessee, either is personal expenses at the place of duty or employment of profit, right? Any benefit or perquisite obtained from a company. Then any benefit or perquisite if it is received by the representative assessee, right? So then after that, if you look at it, it talks about the deemed profits chargeable. Then it also talks about the capital gains, value of any benefit or perquisites, so winning from lottery, profit of any business of banking, keyman insurance policy sum received, employee contributions, fair market value of inventory. So there are a lot of categories of income which are included over here, right? So this is a very, very inclusive definition, and we are going to look at each of that once you go to a specific particular chapter. Now again, coming to the definition of the assessee, right? So the definition of the assessee is important because the assessment is going to be taken care for the assessee. So even though the tax is on the total income of a person, but for the purposes of the act, the person is an assessee, because from the assessee, the assessment will be made. So assessee means a person. It is a person. Person definition is very important, what we have seen 277. Assessee means a person by whom any tax or any other sum of money is payable under this act. So assessee is any person by whom any tax is payable, and includes every person in respect of whom any proceeding under this act has been taken, any assessment proceedings are there for the assessment of income or for the loss or refund due, for the assessment of the income of any other person in respect of which he is assessable or of the loss sustained by person or refund due. So in case of any other person also, if he is assessable, maybe due to the clubbing of income, maybe as a representative assessee, every person who is deemed to be an assessee under this act, or every person who is deemed to be an assessee in default under this act. If you make any default, you will be considered as assessee in default, and that is defined separately. That you will learn in the TDS TCS provision. Okay. So students, one thing, I just want you to share the Zoom ID so that all of you can join and basically ask any sort of doubts that you may have. So I'm just sharing here the meeting ID so that you can join it. Sorry. It is 870-9473-1167. 870-9473-1167. Please use this ID for joining through the Zoom so that I can clear any doubts that you may have at the moment. All right. I'm available for the doubts before the closure of the session. So this is the Zoom ID that is there. Please join in. It is 870-9473-1167. So you can join for any doubt session, if you have to discuss that. You can please raise your hand so that I can allow you to unmute and ask the doubts. You can raise the hand and ask for the doubt. I can see 2 students have joined already. Radha, Kanaya, do you have any question? Yes, Radha. Let me just unmute you. You can unmute yourself, yes.
Yes, ma'am. Today's session was literally a very comprehensive lecture. So there are a couple of queries. So may I tell all at once? That would be better, I think.
You
Or
can tell one by one because I'll also forget. So you can just say
okay.
one by one and I'll keep answering. Yeah.
Sure, ma'am. So, with regards to the starting of the session, you said that as per the state list, only is allowed for making agricultural laws. So, you said that generally it is exempt. Tax on income other than what you said, other than agricultural income. So, I was not clear about it. So, is
Sure.
agricultural law specifically existing, and whether it's tax on it is exempt generally? So, that was first
Yes.
question.
Sure. So basically, see, the agriculture income is listed in this list 2, on which the state legislature has the power to impose the taxes. So the agricultural income is a state subject. It is not a subject of the center, right? So therefore, on that, the center cannot levy any tax. And that is the reason why from the list 1, it says tax on income other than the agricultural income, right? So because of that, so there are different state laws depending on different states, the agricultural income are taxed, are not taxed. That depends on the state law, right? But from the center, this has been excluded because of that reason. I hope that's clear.
Yes, ma'am. The second one was with regards to the Finance Act. Since you said that the money bill is being passed in Lok Sabha, so just only Lok Sabha's assent is being required for Finance Act, and what kind of amendments is specifically, as an overall picture in Finance Act?
So Finance Act is, see, essentially your union budget, right? So basically, when the union budget takes place, the finance minister presents it, right, in the Lok Sabha. It is introduced in the Lok Sabha as a finance bill, right? Now, after the Lok Sabha, when it is getting introduced, the Lok Sabha will pass that particular bill. Then it goes to the Rajya Sabha. Now, again, the Rajya Sabha, when it basically, it even if it doesn't pass, it doesn't matter. It goes to them, but usually if they don't pass, it is deemed to be approved, right? So basically after that it will go to the presidential assent, and that's how it becomes the Finance Act. Now the Finance Act will contain the amendments to the Income Tax Act, will contain the amendments to the GST Act also. So that is basically concerning any sort of tax amendments, either direct, indirect, or any other security transaction tax, any sort of those taxes which has implication on the tax, that is basically done through the Finance Act. So any sort of changes that are to be introduced in the tax rates or in the Income Tax Act, that happens through the Finance Bill or the Finance Act.
Okay. Okay. Next one was with regards to the notifications. I guess, ma'am, whatever the amendments is being brought in the particular act, that is only being notified in the official gazette. And
No,
okay.
it is not like that. See, any sort of amendments that are to be taken care, that in the act are to be done through the Finance Act. Now, obviously, Finance Act also gets notified through the official gazette. But the notifications that we are speaking under the Income Tax Act here are basically to notify either the income tax rules, to notify the income tax authorities, for which the power has been delegated either to the central government or to the CBDT under specific section. So if you read, certain sections, you will come to know that as may be notified. So as may be notified by the CBDT or central government as the act gives the power. So those are some sort of notifications to, either notify some authority, either to notify some forms, either to notify some sort of, like, let's say income tax officers against whom you can make the application. So those are the notifications which are there.
So that means, okay, I got that point. But with regards to circular, I wasn't clear that what kind of circulars we are supposed to, refer to while studying DT.
See, the circulars which are important for you will be given in the study material. Like, for example, if we talk about the TDS on perquisites. Now, what do we understand by perquisites? Or what sort of perquisites are covered for the purposes of the TDS? Now, the CBDT has clarified through the circular. So that will be mentioned to you at the appropriate places wherever the discussion will be there on those points. So the circulars which are going to be covered in your study material, only those you will need to refer.
Okay.
Yeah.
Ma'am, one of the huge section which you made us read today with regards to section 536, clause F and H, I have query. So with regards to 536F, you said about old or new regime is being opted. So will it be continuing in the new act, or as per the old provisions only it will be continuing that? Like, SSC is opting for old or new regime. So that was one
Yeah.
query. And within the same section, another query was, what kind of deductions are they talking about that can be carried forward in the next year? And you also quoted about the charitable exemption. So I had that query. Yeah.
Sure. So any sort of, let's say, for example, any option that you've exercised. So old or new regime that you are talking about is pertaining to the individual. So for the individual, you are usually going under the default tax regime, which is the concessional tax regime, right? So even when it undergoes a change, it is default. You have not exercised any option with respect to that. So you don't need to exercise an option for the default tax regime. And we are going to see that in the next session. So if it is a default tax regime, if the slabs or the tax rates are undergoing change, so for that, obviously, it will be applicable to you as is, because you have not exercised any option. The option is to be exercised for the old regime. So if for the old regime you have exercised the option, if the rates are changing under the new Finance Act, that will be applicable to you. Now here the option which is specifically made applicable is with respect to, let's say, for the companies who want to exercise the option for concessional tax regime, right? 25% or 15%, 22% or 15%. Now, if they have exercised the option under the old act, that particular option will be valid under the new act also. Now, coming to the deductions. So, if the deductions have been allowed, right, or any exemptions have been allowed. For example, I was talking about the charitable trust. Now, charitable trust have the mandate that their income will be exempt only on the satisfaction of the condition that their income is applied for the charitable purpose. It is not unconditional exemption. Now, if they do not apply for the charitable purpose in India, and let's say that income is not applied for charitable purpose, so therefore the act or the section says that it should be included in the year of violation. For example, if it is applied for the related person, so it should be considered as a deemed income in the year of violation. So if it was exempt in the last year, but the year of violation is this year, so it will be charged to tax in the new income tax act, because the violation has occurred now.
Okay, so that means with regards to only violation, it is being considered in the next upcoming tax year.
Yes.
That was the
Yes.
only crux. And
Yes.
ma'am, just a query which might look like a minor thing, but I want to ask that central government plus CBDT, you were saying together one than one. So it's like only specifically they are being authorized by the main ministry, or it's like a different story?
No, see, as I said, CBDT is the body to administer the act. It has
Yes.
been made as a body to administer the income tax act. So the act itself, at various places, you will see it will say as may be notified by CBDT, as may be notified by central government. Central government is our government, right? But the CBDT is the body which is specifically created to administer the act. It is made of all the income tax officers only. So the CBDT will give out the circulars to explain that, because it is administering the act. So it is, you can say it's a body of, revenue which is sitting there and which is going to, come out with the clarifications in case there are required.
Okay, so there is no as much a central government role in that. It's just limited role.
Yeah.
Okay.
The central government role is to come up with the amendments to the act. And
Okay.
those are going to be final, which is binding on you, me, everybody, the income tax officer. The CBDT's role is to just, clarify the act, come up with the, forms of income tax, all of that, right? Now, that particular thing is more to administer the act. So their power is very, subsidiary as compared to the central government. So therefore, the circulars of the CBDT are binding on the income tax officer, because they are, given by the income tax body at the highest level, but not on the assessee.
Okay, that means central government has the upper hand, definitely.
Of course,
Yeah.
because the act is administered by the central government, by the it's an act of parliament.
Parliament. Correct. Got it.
Yeah.
Just few more queries. See, ma'am, you told us about the golden rule when the act is, interpreting provisions is ambiguous. So does it mean that it is specifically given in the memorandum in the Finance Act and the whole
No,
section? So
no.
yeah, that was the thing.
So basically, see, these are rules of interpretation which have been developed by the judiciary, which have been, understood globally. These are not only restricted to tax law. This is applicable to all the sort of law. You can, apply it to the criminal law. You can apply it to civil law, every law. So these are some of the rules of interpretation which are arising over the period of time. It is more like, a kind of, maybe, I can say a practice, right? It is not something as a statutory thing which is coming into. It is a kind of practice that has evolved over the period of time to understand the laws.
So how I will be able to, reckon that that is being specified, recognize how it has been given? Like I didn't get it, like in the act.
It's
Yeah.
not given in the act, as I said. These are, as a matter of practice, globally, these rules are adopted to interpret any law. And which is like, a common thing to say that, let's say, for example, if I want to interpret any law, forget income tax, I will first give the literal meaning to the terms of the law. Whatever the words are specified. Like, we were going one by one, section 4, we were reading each and everything. So that is a literal interpretation. Now, let's say, for example, if, understanding it literally does not make any sense to me, because what facts of my case are, and if I'm trying to apply it literally, it is giving some absurd result. So then I will try to find out the intention of the law, which is the purposive interpretation or the golden rule, right? Which is a very logical thing to do. So to find out the purpose, I will go for extrinsic aid. I will look at the old Income Tax Act. I will look at the Select Committee report. I will look at the Finance Act, the memorandum to it, to understand what was the intention of introducing such a language.
Okay, I got it. That means it is already
Yeah.
being interpreted by the other acts. That was the thing. Not other acts, other resources, external resources. By
Yes.
that, I would be able to find by my professional judgment. Yes.
Yes.
Now, one thing, ma'am, I would like to know that I was so curious about the new Income Tax Act. So I definitely did a huge study about it, not overall things. So I just viewed about the Select Committee report by the Lok Sabha, which is around 4,570 pages, 4,570 pages. So that, but in that, ma'am, I observed one thing. does that takes the reference in the current Income Tax Act, which is being amended by Finance Act 2026? And I really viewed that there are two sets of footnotes which has been provided. That is from 1 to 99 and 1 to 52. Now, I want to just ask that how it is being connoted or related with it, or whether it is totally unrelated and just Finance Act 2026 is being considered.
See, basically, this particular income tax report, which was published by the Select Committee of the Parliament, right, or the Lok Sabha, we can say. So, essentially, this was on the draft bill which was first introduced, right? So, Income Tax Act, which is there, was first introduced as the income tax bill, and which was studied by this particular committee. So after the recommendations of the committee, after the, lot of recommendations by the people at large, they had invited the recommendation, Select Committee had considered all of that, right? And basis that, this particular committee report was published. So it is not really going to consider the Finance Act, because if you see the date of that particular report also, it is before that. It is not after that. So it has not obviously considered that.
Okay, and the ma'am, one thing which you were during the lecture, there is a confusion which actually TDS section is of 393, and
Yes.
with regards to interpretation section which you showed section 66, and then simultaneously rather than
402.
393 you showed 402. So that was like,
Yeah.
what is that then? That was the thing.
See, every particular like head of income or the chapter has its own interpretation section. So 66 was more to do with the head of income, which is concerning the PGBP. Then you had the 402, which is concerning the TDS chapter. So for every head, you will find a different interpretation chapter, which are consolidating all the definitions at one place.
Okay. Only last two queries now.
Yeah.
Ma'am, what is part 1A and 1B of first schedule of Finance Act? I wasn't able to get it.
Sure. So part 1A is, see, basically the part 1 which was there, it's for the assessment year. Like if I talk about in the 1961 Act context. And part 3 used to be the previous year, right? So what they have done is part 1A, since it is pertaining to the assessment year, because the income of the previous year was in the 1961 Act charged in the assessment year, right? So you compute your income, file your return in the assessment year in the 1961 Act. So the assessment year is still going to be there, right? In the new Income Tax Act also. You are going to file the return. We are filing the returns right now for the previous year 25-26, right? So what are the rates that I'm going to charge for the assessment year to compute my self-assessment tax? That is part 1A. Part 1B is the tax year, is the current tax year, right? So for the current tax year, these are the income, right?
Okay.
And the part 1A and 1B is basically 1A is for the old Income Tax Act assessment year. The part 1B is for the tax year in the new Income Tax Act.
Okay, got it. 1A is like, first priority to older one, and B
Yes.
is for the current one.
Yeah.
And just the last query, ma'am, with regards to Section 4, you said that it is provisions of Main Income Tax Act is overriding Section 4. So I was like, how it can be? Because Section 4 itself is a charging section.
Section 4 is a charging section, you're right, but it is subject to the provisions of the Act. Now, I may give you an example at this point, but I don't know if you will be able to understand it, but I'm just, giving you so that you can make a note, and then at the end, you will be able to understand,
Yeah,
maybe
ma'am.
at the end of your entire syllabus. So there was something called as Section 90 in the old Income Tax Act, okay, which is basically in relation to, like, the section says that the provisions of the treaty will prevail over the act if those are more beneficial. Now, let's say, for example, the act may give a tax rate of 20%. The provisions of the treaty may say that the tax rate should be 10%. Now, if I do not subject the charging section to the other provision, what will happen? I will never be able to give you the tax treaty benefit. So at this point, you will not be able to appreciate what I'm saying because you have not, gone to the international tax class. but you can make a note of what I'm saying, and then you can correlate at that point, and you'll be able to make a sense of it.
Yes, ma'am. I definitely got your point because
Yeah.
specifically in the current Income Tax Act, which I observed, government has I mean the committee has definitely taken a note of the benefit for the assessee, the taxpayers. So for the ease of doing business, as you said, so that's why if a treaty is providing more benefit to taxpayer, then why not? Rather
Yeah.
than to
So that
penalize
was
them.
there in the old act also, and
Correct.
this is something, there here as well.
Yes, ma'am. I got it. Thank you so much, ma'am. Thank you so much.
Okay. Yes, anybody else has any other question? You can please raise your hand in case you have, or you can unmute and speak.
If anyone not there, then I can just ask final query. Like it's for everyone actually, just a common query. Ma'am, DT is a very humongous, even though it is being simplified. 536 sections are there, and it took me a hell lot of days to just understand the overview. So I just want to know that right now we are not having modules. So now how can we just whatever you made a study? I have made the notes, rough notes, but how to study it in a proper correlation? Even though you have said all the kind of principles which has to be followed in the specific while reading the specific sections. So can you just guide me about it?
See, direct tax has always been, very voluminous syllabus, but you have to wait, of course, for the module, and the institute is going to publish it very, very soon. But first of all, you have to be consistent with the LVC, because, of course, independently, if you have to go through, it is going to be very confusing. So the faculties will, take you to the different section. Like, for example, if you see in this particular session itself, we have jumped from 536 to 4 to 3 to 2, back and forth, right? So this is how it has to be read. You cannot just independently go one by one section, but make a reliance on the bare act as much as possible, because that will not only help you for your finals, but even later on, once you become CA, if you have the habit of reading the bare act, the DT or any law, it has to be interpreted by reading it as many times as you can, because every time you will read, you will have a different interpretation. So make a habit from today that you invest in reading the bare act as much as possible, even beyond the module. Module will, of course, simplify the things for you, but it will not never replace the bare act. So that has to be, your Bible for the direct tax.
Bare Act is a actually blessing right now. By seeing the tables and all, I was very happy.
Yeah.
But the thing which was actually amusing me was the footnotes is being given. Okay, because President's assent was received as on 21st of August of 2025.
Yeah.
For the
Yeah.
income tax bill second, which was being issued, right? So there
Yeah.
was a lot of changes in the Finance Act, which was being incorporated right now in the bare Act itself. So do
Yeah.
we need to just remember that what all changes is being done via footnotes,
No.
or like yes, secondly, my query was with regards to the act and the previous bill, because it was a second bill, so should we refer to the draft current, like earlier draft, or it's like whatever is in the barrack, that only I need to do? That's it,
You
my
need to
question.
do what is there in the barrack, at least for the purposes of your CA final. You don't need to, refer to either select committee report, draft bills, or all of that. That is, more for professional interpretation when you are arguing before the courts, when you want to understand the intent. It is more for that purposes. But for this stage, you will have to only rely on the bare act, no footnotes, nothing. Just, what is there in the act after the amendment of the Finance Act.
And even though, and not at, like finance bill, like Finance Act material, we no need to refer that finance bill
No,
also.
because of course everything is incorporated in the new act. So once you're referring that, that should be all.
Okay, just one thing, finance bill, where can we refer, ma'am? I forgot the website for that.
It is there on the income tax website, only the income tax website that we were looking at, incometaxindia.gov.in. On that, you can just have list of all the acts, and there you can select the Finance Act.
Thank you so much. And ma'am, I really want to appreciate you that the way you have, this much sections, the way lucidly you have explained, I'm really very happy to, give
Thank
a
you so
kickshot
much.
for this new Income Tax Act. I'm sure that I will score very high marks in this. Thank you so much.
Thank you so much, and all the best. Yes.
Yes, ma'am.
Any other question before we close the session? Okay, so if there are no further questions, I think we can close the session. Yes. Thank you.
Recording stopped.